All right, sounds good. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Hey everyone, welcome back to another episode of the Amateur Investors. This week, Ben and I will be giving a macroeconomic landscape of how we see the economy right now, what the economy is doing and what we see as the future and where things are headed. Ben, if you want to take it over from there.
Yeah, this is already going to be a very loaded episode because I feel like nowadays, even a few weeks is a generational change in the economy. It seems like there's always something new happening, especially when you factor in what's going on in the Bitcoin space as well. I think the way that we're heading, we're really traversing in uncertain times, and I am struggling with how to value businesses and figure out where to park my money. And I would love to kind of, do a little bit of a volley with you today and see what you're thinking and what is the best course of action, either for us or for our listeners. But, globally, we were just faced with the societal impacts and the economic impacts of COVID-19, which in itself is unprecedented to think that we would be going through a global pandemic akin to the sort of shutdown of like the Black Plague. It wasn't that severe. I know for a lot of folks it was. But to see the whole world shut down in an era where everyone has smartphones, more people have smartphones than clean water. And we're largely interconnecting the internet, but we were still shut down by a virus that is too small to see. So that in itself adds some variability to what businesses thrive and which ones fail going forward. I'm thinking about just equities in the near term. I think it really showed some vulnerabilities for folks that were mismanaging their balance sheets, for businesses that were unnecessary or were not prepared to go into the forced sort of digitization of business. So that's one factor. But I think a year later, I just want to give a few facts of where we're at now. And the COVID-19 recession is different. And, no recession really is the same. I think a lot of people like to draw analogs between every recession. It's always like, oh, this is having some similarities to the dot-com boom. I'm sure you've probably seen an article on CNBC. The bubble is about to pop. Like, yes, it may, but you really don't know where we are in the bubble until it does pop, to be quite frank.
Yeah, or even tweets from Michael Burry. He's the guy that was infamous that predicted the 2008 crash. I forget what's the name of the movie. I think it's called
was that The Big Short?
The Big Short, yes.
Yep.
And portrayed by Christian Bale, but Michael Burry is the famous guy that was shorting the housing market and saw it crash, and he's already tweeting out and saying that there's potential crash coming in the near future.
Yeah, and with those types of things, like I think it's a good point of information to start doing some research and see if there's some credence to those folks, I guess, sentiments or research bases. If they're lacking any research, I wouldn't take too much heed into it, because it's very easy to just call everything like Goldman Sachs does with their stocks: buy, sell, buy, sell. And you seem like a genius if you happen to have guessed Amazon, but 99% of the other ones were wrong. So, take everything with a grain of salt. But we are in unprecedented times. And Chris and I, we talk about this on most episodes on kind of where we're at with the overvaluation of equities from a historical basis, some unprecedented levels in the Fed's balance sheet. So just a couple of things I do want to note following the sort of supply and demand shock that was fueling the recession that was triggered by COVID-19. So an interesting stat here is that, recessions, like I said, do come in a bunch of different shapes, sizes, and flavors. But let's just say, for a year later from the COVID-19 recession, U.S. households added $13.5 trillion in wealth, which was the biggest annual increase on record. And in the 2008, the big short recession that we're talking about, households lost $8 trillion in wealth. Chris, any commentary on that point from the hip? To me, I don't know. I think it's definitely we can definitely kind of point to some of the money printing here on the Fed side with just easy money entering the system, but just directionally, it's fundamentally different. That it's adding wealth versus losing it, despite sort of QE existing in both.
Yeah, I think this is something that's very interesting. I would have not expected those numbers. I guess just shooting from the hip, I'm assuming that the wealth that was added in terms of people that own property, people that are investing in the stock market because we're hitting all-time
Yeah.
highs. Obviously, if you were the CEO of a company or the owner of a company like Jeff Bezos, Warren Buffett, Elon Musk, the list goes on. Like, I think that's mainly where the wealth has seen. Maybe less so in the gig economy or people that work as waiters and waitresses and restaurants and small businesses. Those obviously saw a reverse and they definitely lost money, whether they lost their business, lost their job, or a combination of the two. So it's definitely something that the middle and upper class kind of fared a lot better than the lower class, lower and or middle class as well. So yeah, it's very interesting. I mean, where like 2008, like everyone was kind of losing their shirts, or at least that's the way it seemed. That's just firing from the hip. But Ben and I always talk about like reversion to the mean. So, as we're seeing this abnormal, crazy growth with not as much productivity, there's eventually going to be a reversion to the mean. So it's got to revert back to normalcy, basically.
At some point, and
Yeah.
I agree with you. I think well, even just shooting from the hip, you're right. I was doing a little bit of research on those stats, and it really is because of sort of the asset inflation. It's also price inflation that we're seeing now. If you saw our recent newsletter on the CPI, yeah, I think with quantitative easing, like we've talked about this before, with any sort of new monetary creation, whether it's through the asset purchases that the Fed is doing or through UBI, there's a little bit different than UBI because that's a little bit much more direct to the end consumer. But the money always has an injection point. And when you're talking about, treasuries, federal backed securities, that injection point is going to sort of like the upper echelon of folks in net worth, the banks, the high profile clientele. And that doesn't necessarily trickle into, the end consumer or just like the lower middle class. While asset prices continue to inflate, like you said, Chris, you highlighted this, I think in our last episode, is that minimum wage is not inflating to reach record prices. I know it's starting to climb up a little bit, but it's decades overdue, and it's certainly not tied to where it should be. So that is an interesting thing to see, is potentially the effects of qualitative easing over long periods of time from that 2008 to now. That those effects are pretty profound. Just seeing what the power of the Fed to sort of move economies. A couple of things that Chris and I look at in terms of looking at how, on a historical basis, equities are priced, and two indicators that we like to look at are the Warren Buffett indicator and the Shiller PE ratio. And both of them, and I'll give them sort of respectively, the Warren Buffett indicator is at 204.2%, which is significantly overvalued. So a fair valuation would be between 95% to 117%. And what the Warren Buffett indicator is, it's the what is it? It's the price to earnings over GDP.
Yeah,
on the Wilshire 5,000 or something.
Yeah, it's the total market cap over GDP.
Total market cap. Yes, the total market capitalization. I think it's the Wilshire 5,000 or something. It's supposed to be the whole United States market capitalization for all U.S. equities, roughly. And I think I don't know if it's the highest that we've ever been, but taking a look at what the anticipated returns are, to your point, Chris, on a reversion to the mean, based on that number, it's likely to return over long periods of time a negative 3.3% return just by buying the whole market. And in the Shiller PE ratio, which is the cyclically adjusted price to earnings ratio, or the CAPE ratio, or the PE 10, that's at 37.96, you can Google all these links. They're always in our newsletter, so definitely subscribe. But the highest it's ever been in the Shiller PE is 44.19, and we are at 37.96. And that 44 number preceded the December 1999 the dot-com boom, or rather bubble burst, which is a scary.
To give some perspective as well, I think, correct me if I'm wrong, but the Great Depression was 29 was the Shiller PE ratio, I believe.
I believe so.
I think it was like around 29. So we're at 37. So just think of it, dot-com bubble was at 44. Great Depression, it was at 29. We're above Great Depression, and we're approaching pretty rapidly the dot-com bubble. So you hate to say there's going to be blood in the water, but, it definitely makes your ears perk up when people like Michael Burry and other people that I don't want to say are traditional bears or shorts of the market, but basically giving warning signs that, like, there's going to be bad signs to come.
Yeah, and that's a good point. And I think it's good to recognize kind of where you stand contextually compared to like the other sort of unprecedented moments in the economy. It was, I think it looks about, it's either 29 or 30 just looking at this chart. But the fact that we are above the Great Depression and we're approaching the dot-com boom, it doesn't give me like a feel good sort of feeling in my stomach. It's not that when you reach a certain number, the stock market will crash. Like it's not so much of like an if conditional. Like there's obviously a lot of variables, and this is an unprecedented amount of just money being created into the system. So it's not to say that we're in new times, but the point is that reversion to the mean is a very, very robust principle for almost all things. And the mean for the Shiller PE ratio over the, I think since it's ever existed since like what are they measuring it back to? 1870 in this chart, 16.82 is the mean, and the median is 15.83. So we have a lot of ways to go before we come down to that. So like theoretically, to get back down there, the market would have to correct by 50%, or earnings would have to double. And earnings are growing, which is impressive, and they almost have to be given the amount of money injection that's entering the system. But at the same time, just looking at, if you just take a quick 1/39, the inverse, just to get a rough estimate of the long-term returns, you're at about a 2.6% return in the market.
And I think that's with reinvesting dividends too. So that's not even, if you thought, but with dividends, I'm probably break even or a little bit higher, that's probably even lower than that still, which is pretty crazy to think about. It's really funny. Like, Ben and I are very young, I would say, in our investing careers. We're still in our 20s. But, we kind of like, it's funny how technology is innovating, and Ben and I have kind of had the benefit of growing up with, I didn't have a cell phone until I was in high school. And I know that's kind of long for most, but I know many people had it in middle school, but we've kind of seen the benefit of like the world without technology and the world with technology. I still think the financial sector is very, very, very antiquated. I mean, you see Jerome Powell or Janet Yellen go on TV and they're like, we're thinking about, potentially thinking about, but not really thinking about raising interest rates. And the markets react to what a guy or a girl say about how, and like, literally they can move the markets, and, that's the Fed and their influence over it. But, recently this year, or at least since Biden has gotten in the office, with Janet Yellen and Jerome Powell still in their positions, or Janet Yellen being appointed and Jerome Powell still being the chair of the Fed, like, I forget, both of them made slip-ups that said like we were thinking of raising interest rates sooner, and literally you would have thought the world was going to burn. Like all of a sudden there's crazy sell-offs, the market went down 2.5%, 2%. And then they basically had to have an emergency press conference saying, we were not thinking about raising interest rates till 2023 or 2024. So it's so antiquated that there's such panic. It's very emotional driven, and like, panic sell, panic buy, panic sell, panic buy. It just seems so funny.
It's an imbalance of power is really what it shows me. Is that it is, though it is emotional for sure, I think the markets do recognize how much power the Fed really does have, where you can continue to have this just like market euphoria if the Fed chooses to do so,
Yeah.
I think that's the scary thing to me. I agree with you. I think the finance sector needs to change because it's not productive in the way that it exists today, in my opinion.
For sure, for sure. And you even see that just with banks today. I mean, my great grandmother got a grandfather clock for just having her money in the bank. I mean, she lived through a Great Depression, so they were like begging people to put money in there, but like she was getting, 6% return in a bank, or like, crazy numbers that you would be like, what do you mean getting 6% return in a bank? Like, just the economics were way different back then. I would say the customer service is better. I would say the benefits are better. And now people are just getting squeezed thinner and thinner, and keeping in your bank, you're losing money. Like, that's really what it is. I guess one little point I will add,
Yeah.
this is just coming from personal use. The more I guess fixed fixed like expenses you have, whether it's a car payment or a housing payment or a boat or whatever it may be, the more fixed expenses you have, cash, I do see more of an asset now, where I mean, for the longest time, I've been living in my parents' basement. I wasn't going out to bars. I wasn't doing much. I had a lot more money that I could invest or reinvest into market or other different things. With buying a house, if my bills every month are $1,500 or $2,000 a month, like if I have a nest egg of 20 grand, like that's 10 months that I can afford to, basically have a nest egg of paying just the fixed expense of my house and my car and all these different things. So I do see it as an asset. It's more of a safety. And I know they always talk about emergency funds or an emergency saving funds or all these different terms for it. But like, you definitely see it as an asset, as a protection if I were to lose my job, or if like, all of a sudden something were to happen or layoffs were to happen or whatever it may be. Having that nest egg is definitely very important. And not that I didn't value it, but it's like when I didn't have a lot of expenses, so I didn't have much to worry about. I had more money to play with, basically.
Why don't we switch gears a little bit? I think
Yeah.
that's a good transition point for now. We can always come back to more market indicators and conditions. I definitely
For
want to
sure.
do that. But Chris, what are you buying right now? Where are you kind of parking your money? And given, I think we have a pretty similar outlook on the macro environment. How are you trying to position yourself in maybe the next year, 5 years, or even just the next few weeks? Like, what are you doing with your money? And I'd love to hear your strategy right now.
Yeah, so I think I told a lot of people in our earlier episodes, probably in December and January timeframe, I was kind of going crazy with buys of Bitcoin. I will let the record show I have sold none of it. I've only continued to accumulate. But with moving money around, I now have the house that I bought, and I kind of have to rebalance with my new expenses and stuff of the house. But I'm still dollar cost averaging into Bitcoin. If I did have extra money, I'd probably be throwing it only into Bitcoin. That means, while though I have dropped my dollar cost averaging of my Roth 401k and my IRA, I'm still putting money into it. My company match, very important. It's free money. I wouldn't give that up. And then my Roth IRA is just, trying to max it, or not max it out, but just money onto the side that it's more flexible. There's more flexibility with it. And then I'm definitely maxing out my HSA. It's triple leverage tax account. That's probably my favorite one aside from Bitcoin. That's probably my favorite buy, but I set that up at the beginning of the year, and that's set to go all year. So yeah, just kind of dollar cost averaging into the market. I will say, like, with Bitcoin's price at 30K, I like that a lot better than if Bitcoin was hitting an all-time high and the S&P 500 dropped 50%, I would probably reverse. I would still keep dollar cost averaging into Bitcoin, but it's basically like buying the S&P 500 at a discount. I kind of scaled back. I mean, all last year, I was putting 25% of my salary into the S&P 500, and I had a lot of mad money that I kind of threw into Bitcoin. But yeah, now with Bitcoin going down, I mean, the two main factors are a lot of the miners in China have dropped. So the hash rate is continuously dropped. So the difficulty adjustment, we don't have to get into the metrics of that. But basically, right now, with all those miners coming offline, transactions are still happening seamlessly, but it's still very difficult to solve the problem, but there's less miners available to solve the problem. So the block times take a lot longer at times to solve for the next transactions and blocks, basically.
Yeah, on-chain. Sorry, my voice is cracking. I was yelling all weekend.
No problem.
On-chain analysis is saying. I was reading a few articles and just looking at what some people were, plopping out on Twitter. They're saying the difficulty adjustment has gone upward between like 40 to 45% over the past like several weeks, which I guess makes sense given that so much of the hashing power has gone offline and is moving to the United States. I think there's like incentives for miners to move into Texas, and I think to Kentucky. They're
Yeah.
getting like tax breaks as well.
And then even neighboring countries, I think Kazakhstan is, a much smaller country. Most people have heard of it from Borat. But I believe they're trying to pull miners into their economy. They're kind of a poorer nation. So any type of economic stimulus by nature of business would be good for their country as well. I don't know the political and economic climates as well, but I know that was another country that Chinese miners were thinking of moving to. It would just mainly be finding cheap and renewable and reliable energy, basically.
Yeah, this has just been really a case study of how robust the network can be, that you could just shut down about half of the hashing power. And all it takes is just how many blocks until it adjusts again? 2016?
2016,
2016 blocks to be added for the
which is
difficulty
about
adjustment.
every 2 weeks if you do the math,
Yep.
if you're saying every 10 minutes. And I think, people's transactions are still happening. Imagine if I were to say 50% of a company would be wiped out. That's basically with the miners going offline, and basically that things kept moving along without any issue. I think that's pretty incredible. It just shows the robustness. And a lot of the old economists, but professors and economists and people that like China can do a 50% attack. Well, they literally just proved they can't anymore. Like they're losing. The majority of the miners are aside, I think they said 95% of the Chinese miners have gone offline. I guess the 5% are either doing it in hiding or I don't know. They still haven't turned them off yet. But if 95% of the network, it would be very difficult right now for the Chinese government to try and make a 50% attack that they always talk about, or 51% attack to try and take over the network. They're just quite literally pushing them out of their country.
Yeah, at this point, it's almost impossible. And I would confidently say it is impossible. Like it could have been done in the early years of Bitcoin when it was first being like conceived as a network, and it was just a collectible at that point when there's only a few miners, when you're still mining on just a personal computer, right?
Yeah, or GPU mining or computer, yeah.
There's just so much dispersion of mining power out there, and the whole network is fully disincentivized to attack it. And at the end of the day, if you were to attack Bitcoin to try and get free Bitcoin out of it, once that was proven to have been true, Bitcoin goes to zero, and then your loot is worth nothing. So
yeah,
it almost never makes sense to attack Bitcoin other than just for pure malintent.
Yeah. And aside from the hash rate dropping, so basically I'll add one last thing and then we can move on. With hash rate dropping, a lot of the Chinese miners, the only currency they had was Bitcoin. So not only did they have to turn off their Bitcoin, they're not making more quote unquote revenue or money from Bitcoin that they are mining. They now have to start selling their Bitcoin in order to move their operations to other country, or to basically get yuan or whatever currency they're looking to go into, whether it's USD, Euro, Pound, or the Chinese yuan, in order to move their miners. So not only on top of the hash rate falling 50%, people getting scared out saying, oh my gosh, like all these miners are going out. Now miners are also putting downward pressure on the price because they are having to sell their Bitcoin in order to fund operations of moving, logistics, power. The power bill still comes at the end of the month if they're not in a fully, renewable or whatever utility that they're using, they still have to pay. So there was just definitely a lot of downward pressure, aside from on top of Elon Musk and Elizabeth Warren saying, how bad it is for the environment. So I think overall, long-term, this is a good thing. We're seeing further decentralization of Bitcoin mining. Ben and I are greedy to say we'd love to see it to come to the United States. But, if it goes to other countries as well, that's only a good thing as well, and further decentralizes Bitcoin.
Yeah, definitely.
So Ben, I'll ask you kind of the same question you asked me. So what do you see as your investing landscape right now? What are you doing? What's kind of your strategy?
So I definitely don't want to say that I'm out of like equity markets at this point. I will say that I'm still sort of participating in some new companies and new names that are coming into the space, like small positions in IPOs for companies that I think have longevity and are pretty close to a path to profitability. I just find it fun, and I like doing the research on the S1s. On the taxable or the tax advantage portfolio side, I definitely want to continue to keep adding into my Roth IRA or IRA, as well as my 401k, just because that time horizon is so long. And I think it's more important for me to have tax protected gains in there, even if the overall return profile is lower. I just would rather have tax protected gains until I can buy Bitcoin in my 401k. I'm going to continue to add to that thing because that time horizon is so long. That's not until I'm 59 and a half. So I've got sometime. I hope I make it there. And in the near term, definitely overweight Bitcoin and cash at this point. And cash is becoming more important, like you said, than I would have given it credit to, because of some of the indicators we're seeing now. I really do think that we're on the precipice of an unwinding in terms of asset prices. I'll just I have a note here on what the Fed had noted here. I think it was 2 weeks ago, the Fed held their rates near zero, but their optimism over the U.S. economy, whatever that means, they sort of talk out of both sides of their mouth, like you said, that Fed officials are starting to pencil in rate hikes by the end of 2023. The markets definitely responded poorly to that, but they also reiterated that they're continuing to commit to their asset purchase program, which is absorbing about $120 billion per month in assets, which includes treasuries and agency-backed securities. So they're expecting the rates to increase at least 2 rate hikes by the end of 2023. And markets did not view that favorably. And the sort of knee-jerk reaction to that news was definitely a litmus test for how the markets will respond when the rates do hike. Because at that point, money is no longer as cheap as it was when valuations were conducted, 2 years ago, talking from the 2023 perspective. So I want to have cash on hand to sort of deploy it into a market crisis. I don't want to say a crisis, just a market drawdown that we would have seen from like a COVID. Like that was so opportunistic for folks that were well positioned to take advantage of it. Even if you had just a little bit of money on the side, you were just getting better prices than you would have ever.
Even just the stimulus checks alone, once the stimulus checks started coming in April, basically April or May or March, whenever your check came, if you bought something back then, basically you saw whatever stock, equity, whatever, aside from bonds, basically any equity in the stock market has gone up in value. Yes, there is its outliers that didn't or remained flat. But for the most part, if you put it into Tesla, if you put it into Facebook, put it into Apple, Google, pretty much pick a company and you had pretty good odds that it went up in value, basically.
Definitely. And I think with regard to Bitcoin, I see it as a lot of things, but I see it, one, as a hedge against that drawdown. Like it is highly likely that it gets pulled down if the broader market is collapsing. There's not going to be any surprises there. Bitcoin will probably be in the red for those days, weeks. But the nice thing about Bitcoin is that there will only ever be 21 million. There's no company that I have to worry about failing. I'm in Bitcoin. I'm against the inflationary hedge for whatever the Fed tries to do to get us out of that crisis, which they're going to print money out of the wazoo if the economy is collapsing. And the cash side, even if it's being devalued, I can start deploying money into companies that are growing their revenue, have a strong balance sheet, and have some longevity in the market. So I definitely want to have that liquidity and also hedge inflationary protection.
Yeah, and I see when market crashes happen, normally what's occurring, and it is, I've only kind of lived through really one in my time in the working world, but kind of what you see is all asset prices fall. And the reason that occurs is people then start selling whatever assets, Bitcoin, real estate, bonds, stocks, whatever it is, to then deploy that into something else. But in the mass selling of everything, obviously that tanks markets across the board. So basically everyone's looking for the new best opportunity. Because if you think, Bitcoin's going to 1,000x, but the stock market's only going to go up 20%, why wouldn't you sell all your equities as they're before they're crashing fully to buy more Bitcoin in the event that it goes up by that much? And that's just very simple, or layman's terms definition of it. But yeah, I think that's a good point. I think something that's going to be very interesting that I think I'm going to see, or where we as the United States are going to see, is where it's going to be very interesting, because in previous administrations, and I'm talking even the 70s and 80s, just historically looking, when I think it was during Carter's administration, when they were seeing crazy inflation. I think it was called FIN, like Fight Inflation Now. It was the acronym they were using. Yep. So what they were doing is they were hiking up interest rates, and that dropped equities, the stock market, the bond market. Like everyone was hurting. I heard stories of people buying houses, 30-year mortgages, fixed rate mortgages at 13%. Like that's a lot of money that the bankers are collecting on the mortgage that you're paying. And that's, a lot of money. So as interest rates were coming down, I think this might be the first time that we're at near zero rates. If they start hiking rates up, we already know that equities, bonds, stocks, whatever is going to fall. It's going to be interesting if the Fed's immediate reaction is, well, we've seen so much inflation. The next thing we can do is we're going to keep interest rates higher than they were and then just print more money. And like that might be the full QE or universal basic income. I'm not sure if that'll be the solution or the play, but if they pull interest rates up, all of a sudden prices start dropping down across the board and they say, screw, like people are getting, like retirement folks are taking a beating, or all these different people in the economy are taking a beating. Let's just start printing money and sending it out. So then it's going to be weird dichotomy of we're keeping interest rates high, quote unquote, but then we're also printing money. Like how does the markets or the free and open market react to that? And this is just, like I said, this is not going to happen, or I don't know. This is just what I speculate would happen. Because then if they pull interest rates down, then you can see rampant inflation in gas prices, food prices, and they're kind of trying to fight, basic living expenses versus, trashing the market or the real estate market or whatever it may be.
That's one thing I'm a little bit concerned about is whether they institute like price floors or rather price ceilings for certain things. If you've read the Bitcoin Standard, sort of how that's looked in history, that anytime you allow sort of a price ceiling to be instituted in the market, things collapse because you're not allowing a free and open market to sort of find price discovery on what things truly should be worth, because the value is in the eye of the beholder. And that's really what capitalism is all about, is allocating value to what folks determine is valuable.
Yeah. And definitely, I'll add one quick thing. Sorry to cut you off there, Ben. But it's when you start adding those price floors, then businesses say, like, let's just say you set a price ceiling ceiling for the loaf of bread can't be more than $3. Well, then a lot of companies that aren't doing well are just like, well, we're just going to shut down the plant. We can't make margins. We're not making enough profit. We can't innovate. We can't pay our employees. We're just going to start shutting down factories. And then the reverse happens, that price bread reaches the ceiling of what it can be, but then you start to see shortages of it. So then then it becomes almost this weird dichotomy of like a black market for bread. Like I can buy bread for $3, but then I could sell it to my neighbor for $5 because there's none in the markets. So it gets to be this really weird and wonky thing when you start completely messing with the free and open market.
Yeah, and this is speculative, but I wouldn't be surprised if there was some sort of mechanism that was attempted if there was some sort of like economic unrest. But in that situation, you have, bread shortages in the market, but bread producers are throwing away bread. So people are starving, but people are throwing away the bread because they can't live off of it. It really is a catch-22. And then it would even propagate even further to the farmers who are trying to grow wheat. So the folks who are responsible for feeding us can't make money to continue to grow. So it just concerns me a little bit when you have sort of these uncertainties. So Chris, just a statement here, you did the research on it, but the S&P 500 hit a record high last Friday, which coincided right in time on the same day with the Fed's balance sheet hitting a record high at about $8 trillion. What are your thoughts on that?
It just shows, many people have been saying, since 2008, there's not really been true and open and free markets.
Yep.
Yeah, you could say like we live in a free country and free economy and all that, but it's very interesting that people are basically piecing together that the Federal Reserve is buying corporate bonds. So instead of just buying government-backed bonds, like they said they've been doing, they're buying corporate bonds to prop up the economy. There was a lot of speculation that they were buying the big four, as they were called. I think it was Ford, GE. I'm going to mess it up. It was Ford, GE, AT&T, and I forget the last one. But those are the big four companies that a lot of the traditionalists and baby boomers have many dividend stocks, or it's a large component of their portfolios over all these years, because they're companies, they've had a much longer career than Apple, Google, Amazon, Facebook. So while the majority of the wealth is concentrated in those companies, they're kind of, Kathy Woods talked about the zombie companies, not saying that they are, they're still making profits and revenue, but a lot of them are high leverage debt, and they pay a high dividend that a lot of the retiree folks, aside from Social Security and bonds and stocks, like it's a dividend stock that many baby boomers and traditionalists have that they use as fixed income for their livelihood. So if those companies were to collapse or file bankruptcy, you could see a lot bigger problems with basically people not being able to meet their expenses, whether it's property taxes, mortgage payments, if they still have them, food, whatever it may be. So basically, they're kind of weighing one group of people against the other and trying to balance it out and trying to bail them out.
Good point, Chris. So I guess what else are you kind of looking out into to get a gauge on where we are in these market cycles? I know we talked about some ways to price assets in a broad sense with like the Shiller, the Warren Buffett indicator, but are there any macro conditions that you're looking at? What, not even just to like kind of guess directions of markets, but what are some things that like you care about right now that you're trying to just keep your eyes on?
Oh, definitely GameStop's price and AMC's price. I think they
Of
predict the
course.
market really well. No. I think right now, in all seriousness, the thing that I'm really like kind of watching more than I've ever been before is bond price yields. So I'm kind of looking at those in the event that bond price yields drop. I always say this reverse. So in the event that the bond prices yields drop, I'm looking to see if they quickly rebound as the Fed tries to buy more of the bonds to bring them back up, or if they spike up, that means that people are selling them off because they see them as worthless. So the yield has to be higher in order for people to be enticed to buy bonds back in. So I'm kind of really looking at the 10 years kind of been the typical one that people look at, but I've been looking at, the 1 year, the 5 year, the 10 year, and the 30 year. Those are kind of the ones that I've been looking at pretty religiously. And it makes me nervous. Like we're kind of at the end of the rope. So, really intrigued to see how things go and what's next. And, Ben keeps saying throughout this episode, and I completely agree, we're in unprecedented times. We don't have something to base it off of. In the 2008, like we didn't know that the housing crisis shortage, we kind of had the dot-com bubble. We had the, 74 crash, the 85 crash or 86. So like, we really don't have anything in history to compare it to. A lot of people have been using more historical things, of falls of empires. I hope that's not true for everyone's safety and for the prosperity of our nation. But, you can definitely see some comparisons to the fall of France, to the fall of Rome, to the fall of all these different countries as they debase their currency into oblivion. I've not lived through a currency reset or a global currency reset because basically everything's pegged to the US dollar. So this fall would not be just the United States. China would definitely take a beating. Maybe less so of Russia, but a lot of countries, Japan, China, all of Europe, like many of those markets would tank alongside the United States because they are tied to the US dollar. So we don't know. I really don't know, but it's going to be a crazy, painful, and brutal winter when it does happen.
Yeah, I think that's kind of the theme of this episode, honestly, is we are in uncertain times, and it is a little bit scary, honestly. I think that's why diversification is so important, especially in uncorrelated assets. I think people always think about diversification as like, buy Tesla, buy GM. It's like, oh, those are auto companies, and then I'll buy an Amazon, which is an e-commerce. Like U.S. equities, that's what you're buying. You're buying only one thing, and that's U.S. equities. So true diversification with like Ray Dalio's all-weather portfolios to buy things that are just fundamentally different. And it may also be different trade strategies depending on sort of your risk tolerance. It could be, selling options. It could be buying gold, just buying Bitcoin. All those sort of different ways to buy and sell the market is a really good way to hedge your risk over long periods of time and just to get very nice, even returns. That's always the goal, is just to not be scared.
Yeah, and like I said, I'm building up my cash position while I know it's getting debased, and we can even talk about. We mentioned that the infrastructure bill was passed, the $1.2 trillion infrastructure bill was passed.
No, I don't think we really highlighted it.
Oh, okay. Yeah, then we can get into that. But basically, while you're building up your cash position as it's being debased, if you have fixed things, like I said, house, car, insurance, all those different things, if they're at a fixed rate, that cash really protects you in the event of, it won't protect me if bread prices go to $1 million or milk prices go to $1 million. But as long as I can keep paying those expenses, I can hopefully Bitcoin or whatever other things that I hedge, I can sell in order to survive. And it sounds kind of scary saying saying that, but that's just the truth of trying to protect yourself in the event of crazy hyperinflation.
Yeah, before you jump to the infrastructure bill, if you still want to cover that, I did want to tack on some information that I was researching about bonds specifically, because that is one of the biggest items that I'm researching and trying to educate myself on, because it's one area of the market that I definitely neglect, and it's like the 15 chapters of Benjamin Graham's Intelligent Investor that I definitely skipped. But just talking about the past 2 weeks, you might have heard about like the yield curve. There was a flattening of it a year ago or 2 years ago.
I think it's a year ago. Yeah.
I thought it was before the COVID recession.
Oh, right? It was in September of 2019, I believe.
Yeah, it was before the COVID-19 recession, which is crazy to think about, actually. And people were trying to call that, the stock market is going to collapse, it's going to collapse, it's going to collapse. We didn't know that it would come in the form of a pandemic, but the flattening of the yield curve definitely showed that it was primed to have an unwinding. So 2 weeks ago, along with the 10-year falling about 2 basis points to a 1.45% yield, investors were going back into government bonds, but the 10-year rose about 10 basis points by midweek, and then tumbled back down by the end of the week. So the decline in stocks 2 weeks ago came with the Fed's decisions to be a little bit hawkish about the economic outlook, and they caused a pretty dramatic flattening of the so-called yield curve. It wasn't flat or inverted, but it was flattening. And what this basically means is that the yields of shorter duration treasuries, like the 2-year note, rose, while the longer duration yields, like the benchmark 10-year, declined. And the retreat in these long dated bonds indicates that there's definitely less optimism towards economic growth. And the jump in the short-term yield shows the expectations of the Fed raising rates. So typically this will impact bank stocks and bank earnings when this happens, but it definitely has broader implications in sort of being a sentiment indicator for long-term economic outlook. And last week, interest rates rose, but the spread continued to widen. So I think we're getting a little bit of uncertainty in directionally where the markets are heading. So just to give you kind of understanding for folks who are going to keep an eye on where Treasury is going, when you're looking at the historical trend, yield spreads between treasuries of different maturities kind of indicates how the investors are viewing economic conditions. The widening spread typically leads to a positive yield curve, indicating stable economic conditions, while on the flip side, falling spreads as they contract, that's indicating worsening economic conditions may be coming, which would be a flattening or inverting of the yield curve. Mm-hmm. So it's not to say that a certain number is what we're looking to achieve. I think directionally and overall shape of the curves is what to keep an eye on. So bonds, I think, are going to be a really important indicator, and it clearly was an important indicator for the COVID-19 recession. So more to be said about that, but I'm just keeping my eye on yield curves for sure.
Definitely. So yeah, I'll just add, I don't want this episode to go on too much longer, but I'll just add the $1.2 trillion plan was Biden sent it through Congress and Senate, or
was it passed? It passed. The Senate went to him, right? It goes Senate, then Biden, and then Congress, or
I think it's Congress, Biden, Senate. Congress, Senate, Biden, whatever. It passed. It passed. So it includes $400 billion in expected baseline transportation funding, $579 billion in new spending. Of the new spending, $312 billion, which would go to transportation projects, $266 billion would go to infrastructure needs like water systems, broadband, and improving power grids. Personally, this is an area that I see that is of great weakness of our country. Ben and I work for both, we work for a waste energy company. So not saying that we are experts in the electrical grid, but, you saw even in, in 2020 when Texas had that huge winter nor'easter or whatever, it took out a bunch of their power grids. And basically the whole state of Texas was without power for 14 days, 17 days, 3 weeks, something like that. I think that's an area that we've kind of neglected. We set them up probably 50 years ago, or we set up a lot of the new stuff, and then we've never really improved upon them. That's an area that's kind of deteriorating of our economy. Definitely power grids.
That was this year, actually.
It was this year. Okay.
Yeah, it was February. It's so recent. Wow.
It seems like forever, but it's also just yesterday. Yeah. Other tranche of the money was dedicated for water infrastructure, like I said, broadband, new transmission lines. It's kind of breaking down the cost.
Yeah,
55 water, 65 broadband, 73 transmission lines. There's also 21 billion for environmental remediation of polluted areas, 47 billion for resilience projects to deal with climate change, extreme weather events, and cyber attacks. I think it's interesting that they threw the cyber attacks in. I think that's kind of in conjunction with the oil pipeline as well as the meatpacking facility. I don't know in the event that, like, are they paying for more computer programmers, or are they going to hire like a
maybe
security
it's the
firm?
ransoms.
Like,
Maybe it's to pay the ransoms for our weak cybersecurity.
yeah, like I have no idea. So that's pretty much that on the spending bill. Anything you want to add there, Ben?
Yeah, I'm curious to see how this is deployed. It's being touted as like the biggest transportation bill ever passed in American history. So that's interesting. I'm curious to see, I guess, what the long-term implications are and sort of how the money is spent. So the $1.2 trillion is going to be spent over 8 years, which it's a pretty long time horizon. It's not, I don't know. I don't know. I can't even fathom $1.2 trillion to be frank, but 8 years of that spending, that's a guaranteed amount of money that's being sort of injected into the economy for good or for bad. I think these developments are definitely very important, especially more on the infrastructure side for like water systems, making sure that we have clean water for people in the United States. I know that we're in uncertain environmental conditions with, global warming and all of the, I guess, just uncertain things that come with that, whether it's droughts in the West or in the Midwest. I think we need to be prepared for uncertainty. So investing in this is important, but this also further affirms the need to invest in Bitcoin because we've got more money entering the system. So more to come.
Yeah, I think that's pretty much it. I think we'll just wrap it up there. Ben, if you want to show off the mug, I know you probably drank it in the middle of the episode. Our store is open. We got mugs, we got t-shirts, we've got tote bags.
Baby onesies.
That's true. A bunch of my friends are expecting or have kids. I think it'd be funny to dress them up in the amateur investors onesie. As always, you can check out our social media platforms, our website. Our website hosts our store. We're doing the node stuff. I know we talked about it in the last episode. Ben and I are going to publish an announcement on there for the nodes, for building people nodes. Excited to do that. And then we've got another announcement coming still yet. Not yet, but soon.
We're hammering out the details, but I think you guys are going to be pretty excited because I know that we are. So
definitely
more to come.
Anything else to add, Ben?
No, I think everyone just keep researching, investing in yourself. And we're going to keep dishing out the research. But like we always say, if you or anyone has any interest in learning something new, drop us a DM in our email or just in any of our social media chats. We'd love to hear back from you. And if you want to be in the show, drop us a line. But thank you as always for watching.
Have a good one, everyone. Talk to you later.
Bye.